Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm happy to be joined today with one of my associates and also equity owners, Nick DeVito, also a CFP. Thank you for joining me.
Thanks for having me.
So if you look at the 6 areas of financial planning, you got cash management, tax planning, risk management, which is insurance planning, investment planning, retirement planning, and estate planning. The first one is cash management, and that's what we're going to talk about today. And if you really get down to it, it's the foundation of everything what we do.
Yeah.
You got to build the box and go from there. And, typically when we meet with folks the first time, you're obviously identifying what's their goals, objectives, and everything else like that. But what do we do? We're getting the base facts. Mm-hmm. And the base facts, quite frankly, is building their balance sheet. But let's talk a little bit about cash management. By definition, the book definition is what's your income and what are your expenses, and hopefully your income is higher than your expenses. But again, as I started to point out, what we do is we like to take a look at one's balance sheet. We look at their assets and their debts. And very simply, why? Because that is one of the best areas with which you can improve your cash management.
Yeah, not only that, it's the area people struggle with the most. If they do have debt, depending on their debt situation, that is a pain point for a lot of people out there.
It is
the debt. And if you can find a way to relieve that for them or mitigate it or consolidate or whatever that may be, the emotional side of that, I think, is one of the heaviest weights when you're doing any financial planning too, particularly with the debt.
Well, and it's also remarkable that, once you get consumed with debt, how much it takes the wind out of you from an emotional perspective. But in reality, you look at high interest debt, the amount of money that is going out the door on a monthly basis to interest. And as a result, it makes it tough. You're always behind the 8 ball, feeling like you're swimming upstream. You can't ever seem to get ahead. Mm-hmm. So really, we talked about cash management starts with debt management.
Yeah.
And again, so what we like to do is when we meet with someone the first time, we encourage anyone to do is take a look at their balance sheet. They list out their assets and then they list out their debts. Okay. And when you're listing debts, we encourage you to, for each debt, the balance, the corresponding interest rate, and the monthly payment. In some cases, it may make sense to look at when a debt is expected to be retired, in other words, done. Like a car loan may be done in 6 months or whatever the case may be, because what that does is it gives you an idea of when is the relief come.
Yeah, or what to prioritize.
Right.
I mean, especially a lot of people, I shouldn't say a lot of people, there are people out there that have the 0% financing and maybe they don't necessarily understand how that works. Whereas if you don't pay it off in time, sometimes you can get hit with back interest for not being able to pay it off. So it can be a great tool when used properly, but you don't want to do it just for the sake of doing it if you don't have the means to be paying it off at the end of that interest-free period. And I think oftentimes what happens when people go to create their balance sheet, I think it's something that everyone should do, just to give yourself an idea of what you have going on. I think there can be a lot of sticker shock, and I think sticker shock is going to be a consistent theme throughout this when we're talking about maybe debt or expenses. There's always sticker shock with the expenses, but particularly with the balance sheet, knowing what you have going on, to Mike's point earlier, builds that foundation of, well, what can we do moving forward, particularly with the debt. Sometimes people don't even, let's say they have various sources of debt out there. Maybe they know the interest rates, maybe they don't. And I think some people that don't know the interest rates, when they really take a look at it and run the numbers and see exactly what they're spending on interest on a monthly or annual basis, there can be a lot of sticker shock with that.
Absolutely. And it's very easy to get your credit card bill and just like, okay, it's $4,000 and minimum payment is $80. Like, okay, I'll pay $80, or I'm going to pay extra and pay $100.
Yeah.
Okay. Well, the reality of the situation is that whenever you have your credit card payment, it's mostly going to interest. Okay. Unless you're paying your minimum payment, shall I say. Typically what happens is it's a rule of thumb, but it's actually pretty darn close. What happens is if you take the interest rate of a credit card, and I'll use 24% because it's divisible by 12 very easily. If you have a 24% credit card, what happens is that you take your balance, 2% of it is interest each month. And what the credit card will do is they'll charge you a minimum payment of a little higher than 2%. It might be 2.5, it might be 3, because credit card company wants to get some money going towards the balance, or else you're just going to be spinning your wheels for the rest of your life, which I'm sure they don't mind the fact that they're getting paid every month.
Yeah, as long as they're getting paid.
Right. As long as they're getting paid, that's correct. So, you take a look at that and say, all right, how much am I paying for it? How much of that is going to interest? And if you add up all the different credit card debt, and someone's got, let's say $30,000 in credit card debt, which we see often, unfortunately, we see it. If it's averaging 24%, they're spending $600 a month just in interest.
Yeah, I think one thing that's really powerful, if someone comes to us that does have a lot of debt, to your point, is kind of listing out those 3 data points: balance, interest rate, and then maturity, if you wanted to go there, and monthly payment. I think going through and really adding up how much your debt is costing you on a monthly basis, how much your monthly payments are. And one thing we're always trying to do is really twofold. There's kind of 2 ways to attack debt. One, taking a look at the interest and figuring out if there's a way that you can reduce the overall amount of interest that you're paying. And then 2, taking a look at the payment of maybe trying to reduce it if there's ways, or you can maybe extend the debt at a lower interest rate and potentially even reduce payments. Because I think the monthly payments are really what put the most strain on people's cash flow. Sure, the interest is not good, especially when you're talking about high interest debt, but the monthly payments is what people feel. How much they have to pay a month, that's what directly impacts them. Because to your point, maybe they're making minimum payments. Sure, they're accumulating interest, or they're just paying off the interest. They don't necessarily feel that as they would if their payments go up. They're going to feel that a heck of a lot more than their interest rate going up.
Well, yeah. I mean, you take a look at a $30,000 credit card debt, as I pointed out, is just the interest alone. If it's 24%, just the interest alone is $200 a month. Okay. And your payments are typically going to, 200, it's 2%, which is $600 a month. Your payments are going to be $900. And I think if you always made the minimum payment to a credit card, I think it's something like 23 years it's paid off. You take the same $30,000 debt. If you put it in over 5 years, even at 10%, your payment is $600 a month.
Mm-hmm.
And it's paid off in 5 years.
Yeah.
So it's managing it, because you sit here and you keep paying that $900 a month to it. $600's going interest, and it doesn't go away.
Mm-hmm. Yeah, you're barely chipping away at the principal.
Right.
In that scenario.
Exactly. So that is why it's important to take a look at both your assets and your debts, because I come across this a lot, where I'll just continue to use the $30,000 in debt. They have $30,000 in debt, yet they have $40,000 in the bank. And I'm like, well, what's that for? Emergency reserve. First of all, I am going to be the first to applaud someone for having $40,000 in the bank for an emergency reserve, because emergency reserves are a very important financial planning tool. An emergency reserve is there for an emergency. However, if we really get down to it, how often do you have emergencies? And, most emergencies are actually insurable. Okay. Slip and fall, you break your leg or whatever. There's just most automobile accident, a lot of these things, most emergencies are insurable. What's not? 2 major ones. One, I'll call it home and car repairs. But the other big one's losing your job.
Yeah. Mm-hmm.
Okay. Losing your job could be in the form of getting laid off, being disabled, or dying. Now, again, dying and being disabled are things that are insurable.
Yeah.
But losing your job's not. Okay. And so the rule of thumb in the financial planning industry is 3 to 6 months of monthly expenses you should have in your emergency reserve. Why? Because if you lose your job, then you've got time to make up for it. And even then, there's variability. If your spouse works and you could live on that, well, then you're okay and you can have less. And similarly, is how secure is your job? If you both are in union jobs or government workers, the odds of you losing your job are extremely low. And therefore, the amount that you have for the emergency reserve may not need to be as high.
Yeah. And I think a big part of the emergency reserve too is a number that you're comfortable with. Because like I always like to explain to people, there's two sides to every financial planning decision. There's the dollars and cents, and then there's the emotional. And you can't just look at one without taking a look at the other. And the emergency reserve, I find, is a great example of that, where I can sit there and tell someone, okay, you have maybe $30,000 is 5 months of expenses for them, or 6 months of expenses for them. So they're adequate there. But they say, you know what? I don't like to see that number below 40 or 50. Sure. Do they need to have 50,000 there? Probably not. But if it makes them be able to sleep at night and put their head on their pillow, then it's okay to have it. Now, the flip side of that is what Mike was getting at, is where if they have the debt lurking out there, okay, you have this emergency reserve sitting there, maybe you're earning 3% on it. You have debt out there that's costing you 24%. How would you like to earn 24% on your money? By paying down some of that debt. Because if we agree that a dollar saved is a dollar earned, saving money on that interest and saving 24% on interest is essentially the same as making 24% if you pay that debt down.
Right.
And I think that's a mental hurdle some people have to get through, because it feels a lot different having the cash in the bank as opposed to using it to pay down debt. But that's really where the consolidation tools that we'll talk about a little bit really come into play, where, to Mike's point, you may be able to take that $30,000 debt, turn it into a 5-year loan at 10% interest. You're saving money on interest. Your monthly payment might be about the same, and you're actually attacking the principal of that debt.
Right. And yeah, your monthly payment goes down because you were paying $600 just in interest, but your payment was like $800 or $900.
Yeah.
And so one of the other things to take a look at is, even if you are earning 3% on 30 grand is $900. It's $75 a month. $75 a month in interest that you're having to pay tax on nets you what, $55, $60? Compare that to $600. So one of the ideas that we throw out, again, is you take that person who has all that money in savings and you pay off the debt, or a chunk of it. But let's just assume all of it. We have $40,000 in savings. If you took $30,000 and paid off the debt, we just created $900 a month in cash flow. At which point, that same person could turn around and start plowing that $900 back into their savings account to be able to rebuild it again.
Yeah. And I think one thing we run into and have to be mindful of is, you don't, in that example where you take money and pay down debt, there needs to be a level of discipline for that individual. If you're taking that chunk of money, moving it to pay off the debt, yes, in theory, you should then be able to turn around and drive that 900 back into savings. And that's what makes financial sense. But you also want to be wary if you're the type of person that, okay, now they have an extra $900 a month. Sweet, they're spending it. That's where you have to be disciplined by yourself. Now, chances are, if they're able to accumulate that money saving, they are disciplined, but you never know. And that's one thing that we run into. I wouldn't say often, but we certainly run into it, where we come up with these great ideas and find a way to consolidate debt just for people to find themselves right back in the situation a year from now because they were undisciplined.
Right. And they just rack up $10,000 or $20,000 or $30,000 in debt, which also leads us to the next potential solution that I reference, is getting some form of a line of credit to serve as an emergency reserve. You can go to your bank, your local bank, and get an unsecured line of credit. Might be 10 or 12%, but you get a line of credit that might be for $10,000 or $20,000. And basically what it is it's access to money. You don't pay any interest for it. You only pay interest if you borrow against it.
Yeah, the lines of credit behave very similarly to a credit card. If you don't have a balance on a credit card, you don't pay interest on it.
Correct.
Same with a line of credit, whether that's a personal line of credit, a home equity line of credit, which we'll talk a little bit more about. But I think that is something people get a little hesitant on when they feel like, oh, I have this line of credit. Is it going to cost me anything? And chances are probably not, or very minimal,
right,
to actually have that line of credit established. And then that can be a great way, and we're going to touch on that a little bit more, is to use that as a debt consolidation tool. Like you're talking about, maybe you get a personal line of credit that's 10 or 12%. Well, that beats the daylights out of your 24% interest credit card. So I'd rather see you paying 10% interest than 24% interest.
Similarly, you could even take a loan, an unsecured loan, 10, like I said, if you did even at 10%, your payment is going to be about $20 for every 1,000 you borrow. So 30,000 ends up being $600. At least you're paying it down. $600 before is what your interest was every month without even paying it down. Improving cash flow. And at the end of 5 years, it's gone. Okay. Or even if at the end of 3 or 4 years, the balance is down to 10 or 12,000 and you have the wherewithal to pay it off, you pay it off. I mean, it's opening the door. And then the home equity line of credit works the same way, except you're using the equity in your home, which is a beautiful thing because what happens is because it's secured, the interest rates are typically a lot lower. And if you're going to get a home equity line of credit, I always recommend you get it at the bank that you do your regular banking with.
It just makes it a little bit easier if you ever have to toggle money between your home equity line of credit and your bank account. We always recommend that you start there. Now, the caveat I'll add to that is if there's a high maintenance fee, or if there's a high opening fee, maybe you don't go with that bank because there are plenty of banks out there that'll allow you to open a home equity line of credit for a minimal cost, and then there's no maintenance fee. And if your bank's going to charge you $500, I'm just throwing that out there, to open the line of credit, maybe don't go there. Maybe you can find a bank that does it for free or very little.
You shop it. And here in Southeastern PA, it's very good as far as the banking. It must be very competitive in this area because generally speaking, you don't pay for lines of credit except maybe to small numbers to pay for appraisals if the bank does an appraisal or for filing at the court.
Yeah, and the home equity line of credit is not just a tool that if you're in debt, you need to look at. We actually recommend most of our clients get the home equity line of credit, even if debt's not a factor for them, because at least it gives them access to funds should they need them.
That's becomes their emergency reserve.
Exactly. So yeah, to some extent, yeah, it absolutely can.
All right, so we're going to come back in the next segment. We're going to talk a little bit about now talking about income and expenses. So this was the balance sheet. That's the one half of cash management. Second half of cash management is income and expenses. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. In the first segment, we were talking about debts and cash management, that aspect of it. And to Nick's point, we talked a little bit, and just during the break, obviously you didn't hear it. We were talking about debt consolidation and using home equity loans and things like that. Those are great tools. You could use a 401k as a loan. Okay. Get a lot of mixed opinions on that, because you're losing out on the ability to earn money. But at the same time, too, is the interest you're paying to yourself. But it ends up being a 5-year loan, and it ends up being a payroll deduction, which obviously is going to impact your income.
Yeah, and with the consolidation of debt, I mean, really, it's kind of an interest rate arbitrage game almost, where you're trying to find the lowest interest rate within reason from a payment standpoint. Sure, you can maybe cut your interest rate from 24% to 5% per se, but if your monthly payment triples, I'm exaggerating there, well, maybe it doesn't make sense, and you might not be able to do that either. So yeah, really it kind of comes down to whatever the lowest interest rate is, and the levers that you have available to pull depend on your situation. For example, to have a 401k loan, you need to have a 401k with an adequate balance. To have a home equity line of credit, you need to have a house that you've built enough equity in that you can actually get that line of credit. So it really does depend on your situation, but always trying to find a way. Almost always, the credit card is not going to be the best place to go if you're going to look up to rack up debt. That's going to be your highest interest rate. So that's almost, you never really want to go there. Now, you can play the balance transfer game and all that fun stuff. We're not necessarily going to get into that, but really what it comes down to is finding the lowest interest rate so that at least because that's wasted money. The interest you're paying is wasted money. So trying to find the way to waste the least amount of money possible, you're always going to be better off for that.
Right. So let's talk about income and expenses, which is the book thing. So fact of the matter is that, there's not a lot you can do about your income. You can work overtime, you can pull a second job, or you can find another job. most people are not in the position of wanting to change jobs because that creates some level of instability. Now, obviously, if a great opportunity comes into play, we can get a giant raise. Well, it's a beautiful thing, but let's look at the other half of the coin is expenses. And most people aren't aware of their expenses. And quite frankly, that is the area where people have the greatest amount of control.
Yeah. Because people will come and they say, oh, cash flow feels tight. Sure, I ask them what their income is, but what I focus a heck of a lot more time on is, well, what are your expenses? Because to your point, that's what you can control.
I ask people what their expenses are, oftentimes for retirement planning or whatever. And what I like what they do is they say, okay, my mortgage is this and my utility, and they just go down the list and they slide it over. And they say, okay, you need to add about 30 to 40% on that. Huh? What are you kidding me? 5,000? How are you going to add 30 or 40%? I guarantee if somebody adds up 5,000, they're spending somewhere between 6,500 and 7. Why? Because it's all of the discretionary expenses that they're not thinking about. Eating out, ordering in, coffee in the morning and Starbucks. Right. Amazon. Oh my goodness. So it really is incumbent upon taking control of and getting your arms around your expenses.
Well, yeah, and it's kind of funny might not be the right word for this, but you have that conversation. They say their cash flow is tight or their cash flow negative, and they have this debt, and they say, well, I'm spending $5,000 a month. And I say, I don't think so, because if you're bringing in $8,000 a month and you're in debt, you're not spending $5,000 a month. You're spending more than that. And I like, there's two ways to do it. And I like to start big picture, and then we can dive down a little bit more into the nitty gritty of the expenses from an expense standpoint. I like to start big picture and take a look and figure out what your overall cost of living is. Before I even have someone go in and itemize and say, this is my mortgage, this is my utilities, this is what I spend. You don't even need to do that. I like to start with big picture. And what I mean by that is, and a great method that I know Mike uses all the time, is you take a look at your bank account on January 1st. And this is a great time to do it. No better time than right now. The year just ended. Take a look at your bank account on January 1st, 2025. Take a look at the value of your bank account on December 31st, 2025. Usually the bank accounts will have some sort of summary about the money that came in throughout the year. You'll get your year-end statement, and it'll tell you the money that came in. Let's say you know $70,000 came into your bank account, and the value of your bank account decreased by $10,000 from January 1st to December 31st. Well, now you know you spent $80,000 that year, because if you made 70 and you took 10,000 from savings, well, that means you spent 80,000. So that gives you at least the big picture overview of what you spent on an annual basis. Now, what I like to have people do, if we say, okay, well, if we're really trying to cut costs, this is when I'll have people really dive into the individual expenses using, there's a couple methods with that too. You can either look through your bank statements, credit card statements, do it that way. What I personally like to suggest people use is one of the budgeting apps like the Rocket Money, You Need a Budget, Monarch Money, all those out there, really whatever works for you. But what that does is that aggregates your transactions and then can categorize them for you. Now, there's a little bit of training involved if you want to train it to understand what category certain expenses go into. But I find that's where there's 2 points of sticker shock with that. One, when they say, oh my gosh, I'm spending $8,000, $9,000, $10,000 a month. They say, I didn't think I was spending that much when they look at the overview. And then when you dive down, we're spending, then they're looking at the details of where exactly their money's going. And they say, we're spending how much on Amazon every month? We're spending how much eating out every month? There's really 2 levels of sticker shock. But in order to attack the issue, if the issue is cash flow and the issue is spending, you need to know where your money's going.
That's correct. And so I did an exercise. Of course, I'm old school. And this is before they had all these apps. I did it twice in my lifetime, once in 1995 and once in 2008, where I literally had a spreadsheet. Trust me when I tell you it was elaborate. Multiple columns, and every single day, every darn dime that I spent, I literally entered into the spreadsheet. Sounds like a major pain in the butt. Once I got used to it, it's about 20 to 30 minutes a week. And so what I did is I categorized, the mortgage, the home equity loan, my car, my wife's car, and insurances and utilities, food, separated from dining out, and kids' activities, and so on and so forth. And then I got all the way to the end after I used up about a dozen columns, and I said, miscellaneous. And it turned out that miscellaneous column was my highest column. It's discretionary spending that you're not thinking about, above and beyond. It's the Christmas gifts. It's the car repairs. It's the different things that you spend money on. It's remarkable how much that is. And yet when I looked at all of my other categories, it was remarkable how consistent they were. Now, consistently, $250 a month for gas. It might vary a little bit because I might have had an extra tank of gas at the beginning or the end of the month where I had 5 this month and 4 the following month. It is remarkably consistent with a lot of your stuff. But what it does is it allows you to look at it and differentiate. And this is a hard task to do. And when I say hard, it's not difficult. It's difficult emotionally. Being able to separate needs from wants. Okay. You don't need to dine out 3 nights a week. Okay. You may want to dine out, but you don't need to dine out. And these are things that if you really take a look at it and you then average the number of times you dine out and the average amount that you pay, do not be surprised if all of a sudden you're like, wow, $500 a month I'm spending on dining out, where had we eaten in, it might have been $100 a month. Right there is $400 a month.
Yeah.
Okay. And is that a need or is that a want? In my opinion, it's a want. It's an enhanced, going out. It's remarkable hitting the bars and whatever the case may be, how expensive that can be.
Well, I think it really, with a lot of things when it comes to financial planning, it's all about priorities and what is your top priority. And what I encourage people to do with anything, whether it's dieting, exercising, or budgeting and spending, is it's very difficult to go cold turkey. And the example I'll use is Mike said, okay, well, you find that you're eating out 3 times a week. I'm not sure. In a perfect world, you go from, if you're trying to pay off debt or you're trying to spend less or you're trying to attack whatever, in a perfect world, you go from 3 to 0. You go from, we eat out 3 times a week to we eat out no times a week. That's difficult for a lot of people. Not everyone's able to flip that switch. So what I will oftentimes have people do is almost weaning yourself off it. Okay, you're at 3 times a week now. Can we bring that down to 2 or 1? Let's start there and start small, because it's very daunting. To Mike's point, from an emotional standpoint, a lot of times, particularly with spending, it's very daunting when you're overspending by a couple $1,000s a month and you have to slash everything at once. Weaning yourself off slowly, and then not only that, but seeing the progress you're making. And I think when it comes to paying down debt or reducing your spending, tracking it goes a long way. And I know it's something you talk about all the time, particularly with the debt, is if you track your debt every month. And if you're working towards paying it down and you're actually able to do that, watching and chart it too. Watching that chart come down over time is really motivating to maybe where you're tracking your spending and you're seeing it going down consistently. Well, maybe watching it go down helps you take it from eating out 3 times a week to not eating out at all, because you can see the real-time results of your efforts.
This is beautiful. Nick's just talking about me in 1995. That's what I had done when I had cash management issues. And I realized that I had a lot of credit card debt and I had a lot of other debts and everything else like that. And I finally one day said, I'm grabbing the bull by the horn. And what it took was just awareness, like any 12-step program. Step 1, become aware. Okay. And I then listed what I had and I'm like, whoa, this is worse than I thought. And then I created my spreadsheet. And oh, by the way, unlike what Nick said, I cut everything out. I literally went to 0. Okay. Wasn't easy to do.
Mm-hmm.
Okay. Tell you the extent I went to 0. Not only did I no longer stop, I didn't do Starbucks, I was Wawa. I made coffee at home. I am saving $1 a day. Saving more than that, because the next day I add 1 scoop to it. And then the following day, add 1 scoop, and then I'll replace the coffee grinds. That's how crazy I was, because I was so dedicated and I had a lot of debt. I set a goal for myself of paying it off in 4 years. But then by graphing it and watching the graph go down, I got it done in 2 years, which was monumental. I just couldn't believe probably less than 2 years, because I remember getting a bonus and just saying, I'm done, and paying it off. And what a relief. But you know what? It dramatically improved. It was an educational process. And if there's anything that you can possibly do here, it's becoming educated in your own stuff. To your point, I've been finding, I'm not here to advertise any particular thing, but I'm seeing a lot of commercials on TV lately for Rocket Money.
Mhm.
Okay. And it's kind of cool. And it was like a dudes out there with like this helmet on. He's like kind of an idiot, but it's a separate issue. And he's like, well, interview, do you know how many subscriptions you have? Yeah, I got 2. Well, it will review the subscriptions. No, you got 13. Oh, and deleting them right from the app. And boy, I need to do that with my TV.
Yeah.
I got channels I never use.
Mhm.
Okay. I admit. And I got a channel that somewhere disappeared. ESPN fell off somewhere. But the long and short of it is it's becoming aware. And we all do it. Become aware, you can probably knock a lot of your expenses down.
Yeah. I mean, a lot of time it's just out of sight, out of mind, bringing it to the forefront of your mind. It's a lot easier, to your point, to attack it when you know what you're attacking.
Absolutely. So, in conclusion, we're going to wrap up the episode now, is that cash management is the foundation. Okay. We're not even talking about investment planning or retirement planning, because guess what? If you're negative cash flow or you're choking every month, you need to fix that first. Once you do that, trust me when I tell you, and I can speak from experience, that the moment you get that monkey off your back, or that 800-pound refrigerator carrying on your back the whole time, it is incredibly relieving. That's the one piece of it. Now, all of a sudden, you realize, hey, I was able to take $1,000 a month and aggressively pay down my debt. Well, look at what $1,000 a month can do for saving. Now you can increase your contributions to your 401k. You can increase your emergency reserve. You can take a vacation now. You can do a lot of the things that you wanted to do before. You can do that now once you clean up the debt and improve your cash flow.
Yeah, absolutely.
So anyway, I hope you got a little nugget out of this. I thank you for joining. I encourage, if you ever have any questions, please do not hesitate to call. We can be reached at 610-422-3773, or you may go to our website, which is www.MAA, that stands for Menninger Associates, MAAplanning.com. Again, it's www.MAAplanning.com. Inside the website, you have the ability to reach out and contact us, and we'd be delighted to reach out and help you, sit down with you, whatever it is that we might be able to do to help. So I hope you got something out. Thank you for joining me again. I appreciate it.
Thanks for having me.
You bet. I hope you have a wonderful day and a wonderful week. Thank you.